All right, welcome to this explainer. I'm your host, and today we are tearing right into the Q2 2026 financials of Thule Group. Look, right now the markets are totally volatile. Consumers are definitely hesitating, and those macroeconomic headwinds, they are blowing hard. But right in the middle of all this noise, you've got companies executing these absolutely ruthless micro-strategies to essentially manufacture their own growth. Today, we're putting Thule under the microscope to see exactly how they're navigating this storm. Okay, let's dive into this. We are on the clock for a rapid-fire sprint through their Q2 performance. We're going to hit the hook and overview, break down growth and catalysts, analyze their financial health, and map out the sector landscape. Let's get to it. Section 1. Hook and Overview. Why Thule matters right now. So Thule is an absolute global powerhouse when it comes to premium outdoor lifestyle gear. We're talking roof racks, bike carriers, rooftop tents, basically the stuff that drives active lifestyles all over the world. But here's the underlying tension. Their physical market dominance relies heavily on discretionary consumer spending, and that directly collides with today's highly uncertain global economy. Q2 is literally their make-or-break peak summer season. This is the exact quarter where they either prove their resilience or crack under the macro pressure. Section 2, Growth and Catalysts, the expansion pipeline. So how are they aggressively hunting for new shareholder value when the rest of the market is just playing defense? Well, what's really interesting about this slide is how Thule's CEO explicitly defines their growth engine. It's called the champion strategy. A champion isn't just, a popular product. It is a category where Thule acts as the undisputed market leader in a niche space, armed with the firepower to out-innovate competitors at every single turn. They aren't trying to be everything to everyone. They are dominating specific, highly profitable niches. Notice the stark contrast here. On one side, you have their established cash cow champions, roof racks, bike carriers, RV awnings. But on the other side, that is their ambitious expansion pipeline. They are aggressively moving into all-terrain strollers, dog transportation, and child car seats. Thule's stated goal is to scale from their current 6 champions up to 10 by 2035. This is a highly calculated land grab for premium consumer demographics. And they aren't just building organically, right? They're buying. In Q2, they finalized the acquisition of Curly AG. It's a premium Swiss dog harness maker. And yeah, the luxury dog market is booming right now, and Thule wants a piece of it. They snapped up this asset for 114 million Swedish krona, which translates to a very reasonable 7x EBITDA multiple. This is just a ruthless, direct execution of their pet transport expansion strategy. They spotted a future champion category and immediately bought an established asset to just accelerate their market share. This move also brilliantly illustrates their total commitment to internal efficiency. They're deploying 450 million Swedish krona to heavily automate their logistics facility in Huta, Poland. But here is the massive so what for investors. This massive capital expenditure is engineered to generate 100 million krona in annual savings, effectively creating a 75 million krona permanent positive impact on EBIT by 2028. Honestly, this is exactly how you protect your margins in a high-cost environment. Section 3, the financial health breakdown. Rapid-fire trends. We know the strategy, so let's look at the actual Q2 balance sheet. Anchor your eyes right on this number, 2.5%. That is their organic revenue growth for Q2. Think about that for a second. In an environment where consumers are seriously hesitating on major purchases, squeezing out 2.5% organic growth right in the middle of their make-or-break peak summer season, that is a massive testament to their brand's strength. Next up, 22.8%. That's their adjusted operating margin for the quarter, up from 21.6% a year ago. Despite rising raw material costs and stubborn inflation, Thule is actively increasing their profitability. It's a staggering proof point that their intense focus on premium champions and internal efficiency is actually working on the ground. Which flows directly to the bottom line. Net income for the quarter sits at a really robust 537 million Swedish krona. That represents a solid 4.7% year-over-year growth. The business is generating serious cash. So the crucial point is, to keep a realistic picture, we have to look at their leverage. They're sitting on 4,063 million Swedish krona in net debt. Now, while their margins and income are phenomenal, they are actively funding acquisitions like Curly AG and massive capex projects like that Poland facility. Managing this debt load while maintaining their dividend policy, that's going to be the true test of management's discipline over these next few quarters. Section 4, Sector and Competitor Landscape. Macro versus micro. Now, we really need to weigh Thule's internal execution against the harsh realities of the broader sector, because these are the dark clouds currently suffocating Thule's competitors in the auto and RV sectors. The CEO explicitly called out geopolitical tensions in the Middle East, consumers dragging their feet on major lifestyle purchases, and those steadily rising raw material costs. These are stark headwinds. They're completely outside of Thule's control, and they are acting as a massive drag on the entire industry. But here is exactly how they survive it. Take a look at their geographic breakdown. 72% of their revenue comes from Europe, which actually saw a healthy 4.3% organic increase this quarter. This European dominance is successfully anchoring the balance sheet, basically completely offsetting a 2.3% contraction they saw in North America. Regional diversification is quite literally saving their top line. And finally, this is exactly where the money comes from. A dominant 54% of their revenue is generated by sport and cargo carriers. The core business is ironclad. But notice that active with kids and dogs wedge sitting at 13%? That was actually their fastest growing segment this quarter, surging by 7.9%. That proves their expansion pipeline into new champions is already finding real traction. So what does this all mean? It leaves us with the ultimate question as we wrap up this explainer. Can Thule's microstrategy of dominating these niche champions and relentlessly automating their operations continue to insulate them from macro volatility long term? I mean, they absolutely crushed Q2, but as consumer hesitation lingers, Q3 is going to be the real battlefield. Keep your eyes on their margins, watch that debt level closely, and track exactly how fast those new champion categories scale up. Thanks for joining me on this deep dive, and stay focused out there.